back. Robert Kiyosaki, Rich Dad Radio Show. The good news and bad news about money. Once again, you want to listen to this program at your own time, go to Rich Dad Radio app, available at the App Store. And then also all of our programs are archived at richdadradio.com. Listen to this program again and again and again. And now a very important part of the program is Ask Robert. Then once again, you want to ask me a question. No guarantees we'll answer it. But if we do, we'll send a special gift. So ask Robert at richdadradio.com. Melissa, what's the first question?
Our first question today comes from Carmine in Long Island, New York. Favorite book, Unfair Advantage. It says this: according to history, when currency collapses, what happens to rents, debt, and real estate value during those time periods?
Okay, once again, we have Andy Tanner and Matthew Kirchhoff as our guests today. I'll just tell you this much. When I study economic or currency collapses, the first thing you want to do is you don't want to be in that currency. If you can understand that one. Because when I studied the Weimar Republic, which collapsed around 1928, 29, is the people that got hammered were the German people. The people that got rich were the German people who moved the money to Switzerland and to England and things like this. So the point here is this: you do not want to be in the currency. You start with that one. So one of the reasons I'm in gold and silver is I'm outside the currency.
Well, that also goes back, Robert, you say savers are losers. This is a prime example of if you're saving your money and the value of your money is going down, 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 you're losing.
Yes, and the charts show that in the last 100 years, the U.S. dollar has lost 95% of its value. It won't take another 100 years to lose about the last 5%. You cannot keep printing money and continue to hold the value up. That's why savers are losers. So the thing about currency, you don't want to be in it. Any comments there, Andy?
One of the advantages of having agility in paper assets is to move it, just like you say. So when, if I were in the Zimbabwe market and it's going up huge, well, the currency, Matt was saying this, the currency goes down faster than the market goes up. I want to be able to move that money to a different place in a different market.
Yeah, you don't want to be on the Titanic as it's going down. Any comments, Matt?
When you do see a currency collapse, a lot of times you see, very strong increases in value, for example, in real estate or in the stock market. And a lot of people, will see those big gains and sort of smile thinking that they're gaining wealth. But what they don't realize is that the currency is actually losing its value faster than those investments are rising. So at the end of the day, you're still sort of SOL.
Yeah, that's like the saying, if I bought a ticket for the Titanic, what should I do? Don't get on it. Next question, Melissa.
Our next question comes from James in Toronto. Favorite book, Unfair Advantage. He says, I know you don't give direct investing advice, but do you still feel that silver is a good hedge against this process of quantitative easing that is still taking place to fight deflation?
I answer this question every single time. A lot of times I'm going to answer it, but look, you've got to do your own research. You've got to understand. First of all, the answer is that silver is more valuable than gold today simply because silver is an industrial commodity. It's also a precious metal, so it has two functional values. Precious metal and industrial commodity is used in water purification, is used in aerospace, is used in electronics. And gold is only hoarded, so there's actually more gold today than silver. And that's a really imbalance right there. But this is the point I want to make really quickly, because I was just talking to this friend of mine. And he's a very smart guy, and he wants to know how to invest in real estate. So I sent him out and say, go find me 10 deals. And look at 10 deals, find the best one. So he calls me back. He says, I found it. I said, what is it? He says, it's a house, $85,000, 20% down. I said, yeah, what's the deal? That's the deal, he says. It's $85,000, 20% down. I said, that's not the deal, that's the price. That's the deal. I said, well, tell me why is the deal? He says, what do you mean? And this guy has no idea. He doesn't know the demographics of the area. He doesn't know the rents in the area. He doesn't know the comps in the area. He doesn't know the tax rates in the area. He doesn't know the jobs in the area. Besides, he doesn't know anything about the investment. All they know is price. And the reason I say this is this. For most of you out there listening, you look at the price of something rather than its value. And you've really got to understand how is it valuable in the economy. So I'll just give you a big tip. Silver is consumed, gold is not. That's a pretty big tip. What do you have to say about people who don't know what they're buying? I mean, they look at the price. They don't look at anything else.
That's just a huge sign of lack of education, because investors are always looking at the return.
But also, is what is the intrinsic value of the asset? Yeah. In other words, silver today is $19. What does that mean? It doesn't mean. What I want to know is how is it used? How is it functional in the economy? Matt, any comments on that?
Yeah. But I'd like to go back to the whole aspect of quantitative easing. I've written a lot on this subject.
Wait. I'm not done.
We'll come back to that.
Yeah.
Let's do this.
Matt, all I'm saying.
I'll ask that question after this.
Yeah, all I'm saying here is that most people look at the price. Look at Facebook as more valuable than Disney. Are you kidding me?
The price of anything is just what someone else is willing to give you for it.
Yes.
It's completely arbitrary. You could add a zero to everyone's bank account and the price of everything in the economy, and not much would change. So yes, what we really need to be concerned with is relative value.
I meet so many guys that, who say, well, it's so expensive. I said, as compared to what? What is it worth? Facebook is not worth its valuation as compared to Disney, but Facebook today is more valuable than Disney. 20 years from now, Disney will still be more valuable than Facebook, but people will chase the price and all this stuff. And what I'm really getting at here, investing is not the price. It is your education. It's understanding what is around it. So I'll say it again. It's all tied together. Silver is valuable because it's got use in the economy. Gold doesn't. The same as oil. Why do I invest in oil? The price of oil will go up and down, but 20 years from now, they'll still be using oil. They might not be using Facebook or Twitter. And these are some of the things that you've got to evaluate. Well, like that goofy friend of mine, he says, well, what's the best investment in the area? He says $85,000, 20% down. So why is it valuable? They don't know why it's valuable. They have no intrinsic value to it. What is it useful for? That's really the question. So when you're investing, you better know what is its use. How does the economy really need it? If I say I got 5 cucumbers today and there's no cucumbers, those are very valuable cucumbers. I got 20 billion cucumbers, they're not as valuable. So in all this, that's what it really means here. But most people are chasing price. Oh, the price went up, the price went up. And that's what we just talked about, was when the currency collapses, the prices will go up and you'll chase the price again.
I want to just take this opportunity, since we've got the two experts here in the stock market, Matthew and Andy. James asked about quantitative easing. So, Matthew, let me start with you. What is your prediction on what's going to happen with quantitative easing?
My prediction is that the Fed's going to continue tapering, as they've done for the past roughly 6 months. And I actually don't believe it's going to have a negative or incredibly adverse reaction in the markets. It's more or less been accepted and priced in at this point. And so, and we're kind of on the last stages of the taper. So pulling away this last little bit of quantitative easing, I don't think is going to rock the market very much.
Let me give you the negative side to that whole thing. The reason they have to raise interest rates is because if the economy collapses again, if interest rates are where they're at, they can't do anything. If interest rates are, let's say, at 1%, they can't go much lower than that. But if they can raise it up to 5%, when the economy crashes again, they can lower the rates again. So they really need to kind of keep that rate so they have something to do. Let me say something. One of the biggest threats we have right now is this thing called ISIS. If they come over here or something like that, they're going to have to, it's not about quantitative easing and all this. This baby comes down so hard, so fast. And that's really what I think about. It's not about what Janet Yellen's going to do. I want to know what Boko Haram's going to do or ISIS is going to do. And that's why you've got to get real. That's why I still invest in oil, because no matter what happens, if ISIS attacks or not, oil is still going to be used. Same as silver, it's still going to be used. Same as housing, it's still going to be used. And really, that's the way you think as an investor. You keep wondering what Janet Yellen, this old lady, is going to do. You got to be kidding me, man. Next question.
Our next question comes from Michael from New Jersey. Favorite book, Rich Dad, Poor Dad. Says this: Robert, I recently heard you say that a credit score is for poor people. Can you please explain in further detail what you mean by that?
Well, credit scores are important, but I never had any. I've always had bad credit scores. It doesn't affect my investing. You see, I said it before. If you have a good deal, they'll give you the money. Like that guy, I said, what's the big deal? It's $85,000, 20% down. I don't have any money. I said, if you told me it was $85,000 a house with 20% down, but I was going to make $2 million next week, I'd give you the check tonight. But if it's $85,000 and 20% down, but I'm going to lose money, I got no money for you. So the credit score is important, but when money is really there, they give you the money. You see, what a banker asks you for sophisticated investors is called a financial statement. And the cash flow board game teaches you the financial statement, assets versus liabilities. Kim and I have had no money, and we've gone into banks with our financials, right?
And
Kim?
that's I think what the credit score is for the individual. If the individual wants to
amateurs.
Individual wants to make a loan against him or her,
Buy a car.
then they use a credit score. But when you and I did our very, very first deal, we had no money. Our credit score, we didn't even have a credit score. It was so bad. But the bank,
I was only down about $800,000. You know, they had flies on my financial statement.
but the lender wasn't looking at our credit score. The lender was looking at if I give you this money for this apartment building, how fast am I going to get my money back? How are you going to pay me back with interest? That's what they were interested in. They weren't interested in the credit score. So the credit score is for the individual looking to borrow money for themselves. That's my opinion. It's not for the investor.
Buy a car or a house.
Yeah.
But it's not for the professional. Any comments, Andy or
Tanner?
Matt?
Something that came to mind is Kenny is amateurs start with the bank and pros end with the bank. In other words, an amateur will try to go to the bank and beg for money. A pro will get private money, and then the bank will cry and crawl to them after they've improved the value of their property. So again, credit score, great investors like Kenny, they start with individuals.
Kenny, you're talking Kenny McElroy of the ABC, the Rich Dad Advisor on Real Estate.
I'm trying to say something. When Kim and I, we found this one deal in Bisbee, Arizona. We made about $100,000 on it. It was no problem raising money because we're making so much money on the deal. People gave us the money. They didn't care about my credit score. So it really has to do, again, with the asset. What's it really worth? How are you going to make money at it? And that's why I'm saying that guy who said 85,000, 20% down, he doesn't know how he's going to make money at it. That's the really problem. Okay, you guys, everybody clear? Matt, final word.
There's so much money floating around that's looking for solid investments that you're right. If you can put a deal together that makes sense, the money's going to be there to back it.
Thank you very much. Once again, Robert Kiyosaki, the Rich Dad Radio Show. If any other questions, send it to AskRobert@RichDad.com. I want to thank Andy Tanner, Rich Dad Advisor, author of The Stock Market Cash Flow. Matthew Kirchhoff, Research Director and frequent columnist for Dow Theory Letters. And I want to thank my sweetheart Kim, and I want to thank all of you for listening. Remember, it has nothing to do with the price. It has to do with value. See you next time.
You've been listening to the Rich Dad Radio Show with Robert Kiyosaki. To learn more about the good news and bad news about money, go to richdadradio.com.